Hi there and welcome to Views from the Top. My name's James Marley and I'm joined today by Tim Carleton, who's the Chief Investment Officer at Australian funds management firm Auscap Asset Management. Tim, good to see you.
Likewise, thanks James.
Let's get into it. Talking broadly, where are you seeing attractive valuations in the Australian market right now?
Well, actually from a sector perspective, for the first time in probably 5 years, we're seeing good opportunities across different sectors within the market, and particularly in the mid-cap and a few in the small-cap part of the market. So that's probably not surprising. In the last couple of years, you've seen mid-caps underperform the All Ordinaries Index by about 12%. That's a reasonable deviation given the underlying companies are actually doing pretty well. And so it's mainly been around a de-rating of some of the valuations that's now enticing us to put capital to work.
Okay, talking about valuations, everyone's been following what's happened in the bond markets. How much of an impact have the changes in bond rates had on valuations in equities?
Well, we've obviously seen the market pull back a little bit. And so as we sit here today, if you look at cyclically adjusted earnings and how they represent value, we're sitting below the 40-year average. And in that 40-year period, you've seen quite a few different cycles. We've seen periods with high inflation, with moderate inflation, with low inflation. But over that entire period, you're currently seeing valuations on the slightly attractive side, and that contrasts with government bond rates and cash rates, which are actually still a little bit under the 40-year average. So if you think about the relationship between equities and what you can get in a bank deposit, you would expect an inverse relationship. Historically, actually, interest rates have been a little bit higher than where they sit today over a long time horizon, and valuations are a little bit below where they've been over that same time horizon. So there is value in pockets, but you've got to be selective.
Okay, and do you think there is further adjustment? Market hasn't gone too far over the past 12 months while the bonds have gone up. Do you think there's much of an adjustment required in equities?
I think the adjustments largely happened. If we don't see significant interest rate rises from this point in time, then we suspect that most of the de-rating has occurred, and it's been obviously more focused on sectors that have elevated price to earnings multiples, and that's why for the first time since we've come out of this very low interest rate environment, you're seeing opportunities in sectors that really benefited from low interest rates. So healthcare, technology, infrastructure, utilities, we're finally seeing some opportunities in those sectors that we haven't seen for some time.
We know that there's a lag effect of interest rate hikes, and when we start to see it roll out in the real world, do you think there's a risk of further earnings shocks?
Well, there's two parts to that question. Are earnings going to decline for some businesses that are exposed to consumer spending? Yes. Is that priced in? Most definitely. So from this point, it doesn't matter necessarily whether earnings are going to decline from where they've been over the last couple of years when there was plenty of government stimulus, interest rates were at record lows, so people had a lot of discretionary spend. Analysts are already expecting that earnings will drop quite significantly from where they were last year and the year before to where they will fall to next year and the year beyond. So the question is really how do earnings play out from this point relative to expectations? And we think that expectations are relatively modest, and we expect actually, particularly in the high quality part of the market, that you'll see a lot of companies beating what are pretty modest expectations.
So that rebasing of expectations, you think that's happened?
Yes.
What about cash? For opportunities, we need cash to put to work. Where are you sitting on your cash balance at the moment?
Actually, we're pretty fully invested. So 2 months ago, we had about 7% or a little over cash on the sidelines. And in that time horizon, we've seen a lot of positive company updates, but valuations that have pulled back quite significantly over the last couple of months, particularly in that mid-cap and to a lesser extent the small-cap space. And so as we sit here today, we've put all of that cash to work over the last 4 to 6 weeks, and we are fully invested. So, and quite excited, to be honest, about the opportunities to buy into some of these businesses at valuations that we consider far more attractive to where they have been for quite some time in some sectors.
Okay, so valuations, part of what you're looking for. You often talk about wanting to own stocks that can compound their earnings at attractive rates over long periods of time. Maybe talk to some specifics around the opportunities you've been seeing.
The most recent reporting season was probably one of the best that we have experienced from our portfolio's perspective. So in a lot of instances, it's around adding to positions that we've held for some time. But in some parts of the portfolio, it's a function of the fact that we don't really think the earnings profile is that different to where it was a few months ago, but the valuations are a whole lot more attractive. So Resmed is an obvious example. Actually, we've owned a very small position in that for quite some time, but we couldn't justify holding a bigger position, so we've added to it. We've bought into Sonic, another business that we've liked for a long time in the healthcare space, and previously we haven't been able to justify the multiple, but it's had a significant derate in the last 6 or so months. So there are parts of the market where we have really initiated positions for the first time, and there are other exposures where we've added to existing positions because the valuation has become a whole lot more attractive.
Now, we heard you talk at Livewire Live back in September with great gusto and enthusiasm for lithium.
Yes.
What we've seen this year is that the lithium price has been quite volatile, and some of the marquee stocks, Allchem, Pilbara, Mineral Resources, are significantly off their recent highs. What is your view on the outlook for lithium?
Oh, listen, it depends on the time horizon, I guess. We have no idea where the lithium price is going over the next 3 to 6 months, but I don't think many people do. Certainly there's a lot more value in the space. And so we think about valuing these businesses based on our expectation for where the price will go and where it will land over the next 5 to 10 years. And we're still of the view that lithium demand will outstrip supply for much of the next decade. We were cautious when prices were extremely elevated a year ago, and we reduced our exposure to some of those lithium names very substantially. And then in the last couple of months, we've been adding to that exposure quite significantly because the valuations are a whole lot more attractive. People have rebased their expectations for where prices will be over that period. And the equity market tends to be fixated on what the spot price is today. So there were a number of reasons that we had expected a pullback in lithium prices. We think that it's not far from finding a base. So from our perspective, that's an opportunity to deploy capital, build back up some of those positions to levels that we'd like to hold over the medium term. And we're not going to try and spend too much time forecasting where the lithium price is going to go on a day-by-day or week-by-week basis, but we do think you should see some form of stability in the next 12 months.
Yep. Why do you think there's so much corporate activity taking place in the sector?
Well, probably for the same reason that we've been adding back into adding to our positions. Corporates are taking a multi-year, if not multi-decade, time horizon, and so they're realising that right now we've got a surplus of lithium in the supply chain. We've got a surplus of batteries for electric vehicles, particularly in China, and so that's depressing the price. But they're looking at the outlook for demand and supply, and I think drawing the same conclusion that we're drawing, and that is that it's hard to see how lithium supply will keep up with demand over the next decade. And so if that's the case, when is the best time to take advantage of a short-term gyration in the price to your long-term advantage? It's when there is a period of oversupply, which results in prices falling dramatically and makes the valuation of some of these businesses a whole lot more attractive than they were even 6 or 12 months ago. So the corporates that can take a longer term time horizon, they're stepping into the market at the moment. There's been an enormous amount of corporate activity within the domestic scene, and that doesn't surprise us at all. So, we do think it's a good time to be redeploying some of the capital that we took off the table only a little while ago back into the space. And
can you give me a sense of how you're playing with the lithium market in Australia?
Yeah, we think the best two exposures are two of the existing producers. So we've had a position in Mineral Resources for a long time. It's an extremely well-run business. They are a very significant lithium producer, but they're also going to become in the next year or so a very significant iron ore producer, much more than they have been historically. And if iron ore prices stay where they are, this business is going to be generating an enormous amount of cash inside the next 12 months. So that part of the business seems to have been forgotten about for the moment, but given the iron ore strength, it's a very material component of their valuation that's not really being considered at this point in time. So there's a two-pronged approach on that front, and we haven't even talked about their emerging gas business. The other play is a pure lithium play, which is Pilbara. Again, pristine balance sheet. The stock has pulled back a fair way as a result of lower lithium prices. but they've got plenty of optionality in this business. They're going to expand production very significantly over the next couple of years, and they've got plenty of near-term catalysts. They're going through a process at the moment to try to work out who their offtake partners are going to be. That's very valuable for prospective offtake partners. So we should see a pretty good deal or two announced over the next 12 months that capitalises on the fact that they have tons of offtake available to go into long-term contracts, something that's very attractive to the battery manufacturers, to the auto manufacturers, and we expect them to be reasonably catalyst rich as a result in the next 6 to 12 months.
I'm going to pick up on the comment you made earlier about Resmed. It's been a really interesting story to follow this year. It's been sold off quite heavily. Yes. There's talk about these weight loss drugs, having an impact on demand for its products. We've also had that rising interest rate backdrop. What do you think the main driver of the sell-off in Resmed shares has been?
Well, I think there are whole parts of the market that actually are looking for a catalyst to de-rate back to the multiples that they used to trade on before we went to a zero or pretty close to interest rate world.
Yep.
So what happened when interest rates declined to virtually nothing is businesses that had earnings growth that were perceived to be independent of the economic cycle saw no change in their revenue growth or their revenue numbers, but a lowering of the discount rate. And suddenly stocks that historically traded on 18 to 25 times PEs traded up to 40, 50, 60 times PEs. So at the moment we're going through an adjustment process, and a lot of the stocks in that space are just looking for an excuse to de-rate. So if we take Resmed as an example, Resmed to us today is around fair value, so we've built a position that's reflective of that. We don't think it's screamingly cheap. It's trading on about 19 times forward earnings. We expect high single digit, low double digit earnings growth over the medium term. So from our perspective, that represents fair value for a stock in the healthcare space that's as high quality as Resmed. The reason it's derated so significantly was the starting point. And so if you're trading on a PE of 35 and you suddenly have a potential downside risk to earnings on a go-forward basis, the value managers will ask, well, where is the sensible spot to start buying this position? And they'll look at its historic range and they'll say, well, pre-interest rates going to zero, it used to trade in a range of 16 to 25 times, maybe because there is a downside risk that we're not quite sure as to how we can quantify that risk at the moment. It should trade closer to the bottom end of that range, and it falls to that level. Now, if the starting point is 35 times, that fall looks very, very dramatic. But the reality is we've only pulled back really to fair value. So we've been active in buying at around these levels. But we wouldn't put it at this point in time in the screamingly cheap camp. It's a whole lot more attractively priced than it was, for the years when interest rates were zero. But I think a lot of these stocks are just looking for a reason to de-rate. So we'd still be wary of stocks that are trading on PEs of 40, 50, 60 plus times earnings because they're not justified in a world in which the risk-free rate, which is what you can get with the RBA or in the 10-year government bond market, is sitting between 4 and 5%, which I might add is where it's sat for most of the last 40 years.
Yep. You mentioned it earlier, but I want to dig into it a bit more. Like, what are your expectations for Resmed's earnings? How are you looking at the outlook for that company?
Yeah, we don't think at this point in time that the fear around the obesity drugs will translate into lower revenue or earnings growth. The segment is still underpenetrated, and there's a question mark about how much of an impact these drugs will have on its product demand. It doesn't surprise us that in the early studies you see the utilisation drop off after about 12 months. You find a lot of people stop taking the drugs, and if you stop taking the drugs, people put the weight straight back on. The second question mark is, to the extent that they do lose weight, does it suddenly mean that they lose the need for a sleep apnea device? And again, the jury is out on that front, but there are certainly a lot of people suggesting that they will still need to use such a device. So the risk to earnings has a number of mitigants. At this point in time, it means that we think that de-rate that you've seen as an opportunity to buy into the company, but we'll obviously keep assessing how this is affecting the space, and if the facts change, then we'll change our view accordingly.
And then just on valuation, you've sort of talked it through us. You're saying fair value for the stock at the moment?
Yeah, the stock's around fair value. It's a well-held stock. It's probably also well shorted in the US. We would like to own this business over the medium term, so we're happy to have a position that reflects our view that it's fair value. If it continued to derate, then we would have the opportunity to continue adding to our position. So happy for it to be a top 20 holding for the fund at the moment. If something changes to make it a more attractive valuation, then we'll add to our position.
Great. Well, Tim, thanks for having a chat with us today.
Thanks very much.
Ladies and gentlemen, I hope you enjoyed that episode of Views from the Top. Remember, check into our YouTube channel. We're adding fresh content just like this every week.